Who's this? Oh, you're an entrepreneur? Oh, you're a real estate investor. Oh, you're trying to learn from those who did it. Well, come into the lab then. Put your white coat on, gloves on, notepad, and let's build, y'all. Real estate experiment. What is happening, y'all? Today we have Mauricio Rauld here with us. Shout out to the French, another French connection there. Listen, I'm excited to have you join Mauricio. Obviously, we connected, and you're doing a fantastic job. First of all, I got to commend you. You're doing a really good job of getting your word out and what it is that you do. And I guess I'll put in the plug. If you guys don't know Mauricio, I would actually like to ask how you actually present yourself to people, because not only you're very involved, you're a speaker, you're obviously an attorney, but you're a very niched attorney. And I want to even hear, even if you would even call yourself that, how you present yourself, because you're also a real estate investor. So tell the people what you do. I know your firm, a Premier Law Group. Is that correct? Is that who you're currently under? Tell us how you would actually, what do you do for a living? Tell us.
Well, the serious answer is I'm a syndication attorney, really an SEC lawyer, but I usually say most people know syndication better than SEC. Right. So I'm a syndication lawyer. The joke, the joker in me says I help people stay out of jail. Because that's what I do. I just make sure that syndicators who are raising money for their deals, just make sure they do it legally in compliance with federal and state laws. And look, let's be honest, you're probably not going to go to jail if you screw it up, unless you're defrauding your investors like Bernie Madoff. Obviously, plenty of people have gone to jail because of violation of securities laws, but most people probably aren't out there doing Ponzi schemes and really trying to defraud and separate investors from their money so they can go on, expensive yacht vacations.
Got it. So we're talking about basically investors who are raising capital today, and obviously, our community is full of investors or entrepreneurs who might be interested in being a limited partner or general partner. Do you want to talk a little bit about who you're really representing, who you're protecting? Because that's a question that I have, right? And later on, I'll probably ask, which side of the question I should be asking, and so let's talk about that. We're talking about syndication. Who are you representing, and what are you really protecting on the deal?
I represent the sponsor, which typically is the individual, although technically I actually do represent the issuer. We get a little bit technical there. Okay. Usually the LLC. So whenever a syndicator puts a deal together, they're going to create an LLC. That's where investors are going to invest into and become part of. That's the issuer, and that's who I represent. And where that becomes important is if there's multiple sponsors, co-GPs, and there's a dispute between the GPs, then I can't really get involved because that would be a conflict for me. I really do represent the interests of the LLC, and if there's a dispute among you guys in the sponsorship, everybody needs to go get their own lawyers.
Really?
Yeah.
So, okay, that's really interesting.
Yeah,
I'm glad you said that.
But I definitely do not represent the passive investor, the limited partners. I do not represent their interest whatsoever. I'm happy to talk to them, but it's usually because a client of mine, the sponsor, is trying to get an investor in, and they've got questions, and I'm always happy to answer questions. But my fiduciary and legal responsibilities are to the issuer and their sponsors, their GPs or co-managers or whatever the structure is.
That's fantastic. And I think that's what we'll get right into today, because we'll get a chance to, I think it's important for the listeners, or we got Mauricio in the lab, and this is really cool because you're an expert and you're able to not only do, I think you sold yourself a little short. You're also an investor, which is cool because you get to see both lens, and you've raised capital yourself. Am I correct? So, yes. So I think it'll be great to understand, what things a first-time syndicator should look out for. But before we even get into that, I want to get into a little bit of you, because I always believe that you're a representation of your business and the person, the individual themselves. And so tell me, a lot of people are lawyers. How did you get into this niche? Did you know right away? Did it transition? And tell me a little bit about that.
I barely knew I wanted to be a lawyer. I honestly couldn't think of anything else to do when I graduated from college. And so it was like a default. I went to law school. And then I got really, really fortunate, and I found a really great law firm to where I got recruited out of law school and went to work for the largest law firm in Long Beach, California. And they did securities and maritime, but primarily I was working on really litigation, but it was both in securities and maritime. And that's how kind of I got to cut my teeth on the securities world. I used to represent the JP Morgans and Prudentials and Goldman Sachs of the world. but it was all litigation. So it was always, you know, whenever one of those guys got sued, that's when I would be brought in. I would then respond to the complaint. I'd go through the discovery, depositions, motions, trial work, appellate work, and all that fun stuff. So it was very antagonistic, right? You're always dealing with the plaintiff's lawyer and you're just trying to defend your client to the best of your abilities. Then what happened is, as I'm living that lifestyle of the law firm, I realized very quickly that that's not what I wanted to do for the rest of my life. I was very, very fortunate to come across the Little Purple Book written by Robert Kiyosaki, The Rich Dad, Poor Dad.
Of course.
That's a long story in and of itself, but that essentially led me to find the real estate guys. I don't know if you've heard of them. They've got a great show and very educational as well. And I was there. I actually left my practice, the law firm, and joined their company and became their general counsel. So I've been Robert Helms' attorney now, personal attorney for the last 15 years. And that's where I really cut my teeth in the syndication specific, no longer doing litigation, but on the syndication side, because back in those days, the real estate guys were just doing a ton of syndications. And so I took over all that work and did all their asset protection. And then obviously liaised with all the outside counsel. And then that kind of slowly, you know, they've got a really large following. And so people started approaching me separately about helping them do stuff. And so with their permission, I started kind of growing this little side hustle, so to speak, while I was working with them. And that kind of grew into a full-blown practice where at some point we decided I was going to go do the practice and obviously retain them as a VIP client. But that's kind of how the business started back in 2006. And, you know, when you start, you do anything that puts food on the table. But ultimately, I withered that down to basically syndication and asset protection. And then about, 7 or 8 years ago now, I made the decision to go full-time, 100% syndication. So as of today, 100% of my practice, my personal practice, is syndication. And 99% of my clients are real estate investors. And I want to say 98% are real estate transactions. I got a couple of with all due respect, I love them all, but some of my crazy real estate clients, they're doing cryptocurrencies, they're doing, you know, stock option trading stuff, but they're all primarily doing, look, multifamily, mobile home parks, self-storage, single family, funds, portfolio, whatever. So that's what I've been doing now for the last 7 years. And then just recently we brought into the law firm a real estate attorney, a transactional attorney, real estate, because everybody thinks that's what I do because I'm affiliated with the real estate guys. So everybody thinks I'm a real estate attorney, and I'm not. And so we brought in a really top-notch real estate attorney, and now she handles all the real estate, you know, the purchase and sale agreement, the title work, the lender work, all that kind of stuff. And I stick to the syndication.
Okay, cool. So let's dive. First of all, that was a great recap. It's really, I find it fascinating to see how people kind of get into what they got into, and because I mean that's honestly what the experiment is all about. You know, you get into real estate and then you open up different doors, businesses. That's who our community is made of. So good for you for doing that. We're glad to have you in here today because now we get a chance to just blast you with questions we've been waiting to ask you. So you mentioned syndication, and then you also said asset protection. Are one and two or one of two the same, or are they different? How would you look at them?
They're two completely different things. I mean, they're related in the sense that if you are doing syndications, you are, at least in my practice, you are investing in real estate. And when you're investing in real estate, you always are owning things. You're never going to own a piece of property, especially if you're syndicating something. You would not own it in your personal name. Obviously, you're putting together an LLC. Okay. And then most of my clients, the syndication is not the first piece of property they've ever bought, right? They've been doing their own personal investing for many, many years, and they're making a step from maybe buying single-family homes for the past 10 years, and now they want to scale up and they want to buy apartment buildings, and so that's why they need to raise money because they don't have $1 million in the bank for a down payment, or they don't have the liquidity or what have you. So it comes parts and parcel, I think, because again, my clients do have all these other assets, and we want to make sure that those are protected. A lot of clients of mine own their properties, their other properties, not the syndication stuff, but their own single family homes. They own them in their personal names, for example, which is just from an asset protection standpoint, the last thing you want to do, because you have literally unlimited exposure. No matter how small your single family house is, maybe you bought something in Texas a few years ago and you spent $75,000 for the property, and maybe you got an 80% loan, so you're really into it for like 20 grand. Yeah. And if something happens in that property, you're going to be responsible, and it's going to be unlimited. It's not just limited to the amount that's in that house. If they have damages in $1 million, $2 million, $10 million because they slipped and fell in your house and they became a quadriplegic or whatever, they're going to come after you for the 10 million. And then you say, well, I don't have anything. You do. You have the ability to create income. You have a W-2 job, and that's always something that people can attach. So you just always want to be careful about, how you hold your assets, especially the dangerous assets like real estate and certainly other businesses. And, you'd never have a business usually in your personal name. So yeah, it definitely becomes part and parcel.
Okay, cool. So I think where I was going that Mauricio is what I'm trying to do is tie the picture of where you come in, because you mentioned that you're not a real estate attorney that does the transactional process. You're actually on the syndication part. So I would like to know, for the rest of us, how early you get involved in, and if you're involved through the lifetime of a deal in the beginning of the deal, because it sounds like there's a syndication part and then there's the asset protection part. So let's go through the nuts and bolts first. We got investors trying to raise capital. You specifically specify in Regulation D, am I correct?
That's 95%. Actually, I would say 99% of my clients do Reg D, but we've done Reg A's before, and sometimes there's other exemptions that we can look into. But yeah, I would say the vast, vast, vast majority rely on a Reg D 506B or 506C offering. Okay,
excellent. So maybe for the listeners, I think I'll give it some good insight, because we might know what that means, but maybe at a quick high level before we get right into it, what would you say is the main difference between the 506B and 506C? I know which is very fundamental for you, but just so
yeah, the main differences is advertising, really the main one. So with the 506B, you are prohibited from advertising. So you cannot I can't go on this podcast and just scream from the top of my lung that I have a deal that I'm raising money for, because that would be advertising. I can't go on social media. I can't go on whatever traditional marketing that I want to do. I can't put webinars or seminars together to pitch my deals. With the 506C, I can do almost whatever I want. I can certainly pitch my deals from social media, podcasts, or what have you. And then the other issue is just whether you're trying to accept accredited or non-accredited investors. And non-accredited investors are people who don't have $1 million in net worth, excluding their primary residence, or don't earn $200,000 a year, or haven't earned for the last couple of years with a reasonable expectation of earning that now. So if you're looking to raise money from friends and family and people who don't have a high net worth, then you're probably going to look at 506B, because they do allow you to take a limited number of non-accrediteds. But then the flip side is that you cannot advertise under a 506B. Other people are really good at advertising and marketing, so they go the 506C route, but then they're limited to only accredited investors.
Okay, absolutely. And that's obviously very important based on either how much experience you've had, or if you're coming into it with connections, etc. Right? As I guess that's what we're going at. Because I specifically saw you post this, and I thought it was very interesting about how stay off of social media. And and that was I saw that was a very notable post, and I think that's interesting because it's the complete opposite of what we're being told. But you have to be very careful from a regulation perspective, is what you're saying, for the 506B.
Yeah, I mean, people, for some reason, I think people just forget that Facebook and all these social medias, LinkedIn, they're all just like your website. By the way, your website's public. Your website is being blasted to the world.
Yeah.
And so anything you put on your website, everyone's going to see, and is going to be considered advertising to the extent you put something in there. And so I don't know if it's just people don't think about it, or I think what it really is that most people understand you can't post about your particular deal on social media. I can't say, hey, I've got a 100-unit apartment building that I'm raising $1 million for. But you also can't what's called condition the market, which means I can't drum up interest for my deal. So even if I indirectly kind of insinuate that I have a deal, but I don't specifically talk about my deal, that's also prohibited. And I think that's where people get a little bit caught up, because they clearly are posting things that reference either directly or indirectly. It's clear that they're raising money, and they're indirectly looking for people to call them and pick up the phone and call them and express interest about their offering. And that's where we'd be in violation of those advertising rules.
Yeah. So it's funny that you say that, because I'm sure, okay, you're being in this space too. And now obviously we know the marketing is everything, and brand awareness. I mean, you're doing a great job of it. So I just came back from, let's say, Growth Con, right? Like a Grant Cardone, who is obviously working with accredited investors. And we're not putting anybody on blast or anything like that, but I think it's a good example because we know who he is. How does he separate the two? Because I believe he even had a tier, I believe Regulation A, tier 2 fund as well. So how does he do that?
That's right. That's why I said, it's not 100% of it is Reg D. So Grant, there is a way to have your cake and eat it too. There's a way for you to advertise, which is what Grant does, and also accept non-accredited investors with some restrictions. And that's called like you mentioned, a Regulation A, a Reg A. We actually call it a Reg A plus. but it's basically a tier 1 Reg A, and that does allow you to advertise and then take non-accredited. The challenge is it requires a mini registration with the SEC. So you can't just do it like a Reg D where you just your attorney drafts up the docs. And it's an exemption. So when I do when I do a Reg D offering or somebody raises money under a 506B or a 506E, we don't run it by the SEC. We just do it, right? And my job is where we do it right. My job is to make sure that you're doing all the disclosures, you're putting all the information that the investors need, but we don't ask for anybody's permission or approval, or it doesn't have to be cleared by the SEC. Under a Reg A, it does. So on a Reg A, you actually file the statement with the SEC. You have a lawyer look at it at the SEC. They'll give you feedback and comments, and they'll come back to you, and then you get a second draft in, and they'll review it, and you go back and forth, and it takes about 6 months to get it through the process and approved. But once it's got the SEC stamp of approval, that's when you can go out and now advertise and take some non-accredited investors. And I say some because you're limited to 10% of their net worth or income, whichever is highest. But that's how Grant is able to take, his investors are giving him $500, $100, $1,000, $5,000, really small amounts because they are non-accredited and they don't have that much. But because it's been pre-approved by the SEC, you can do it. Now, the drawback is because of that process and because it's a lot more work, your fees are a lot higher. Your attorney fees are probably 3 or 4 times more expensive than usual. And then you have all the compliance. I mean, God, it's not quite as a public, if you have a public company that's in the Dow Jones, right, or in the S&P 500, you see these people, they file quarterly reports and they have an annual statement. It's something similar on the Reg A. You've got annual compliance reports, quarterly, semi-annual, entry reports, exit reports, audited financials. So it just gets pricey. And so unless you're raising, $50 million, $20 million, $30 million in a fund, it probably doesn't make sense for you. But that's what Grant and other people who have a big following tend to do in order to get the advertising and also be able to take lower amounts from non-accredited investors.
Okay, that was a great explanation because I didn't know that, and I think that's very valuable for us to know. You should always have someone like you on your team so you don't muddy the waters. But I think it's good. It's good high level knowledge. All right, we like to get real tactical. So we're in a lab right here. We got our lab coats on. I want to get in. So look, there's a lot of us who are maybe investing. They've been using our own money. They've been doing JVs. They have a portfolio to speak. And now it's time for me to raise capital. What is the number one thing as an investor that I should do if I'm putting together a list of things at real high level, right? Because I know you do this every day. What is it? Where do I even start, Mauricio? Like, what should be my first instinct? I might have a small network. I might have some capital. What do I start? Do I call you first and get you on my team? What is the next? What are the pieces? How do I put the pieces together?
Look, I think if you really want to talk high level, the first thing you want to be doing is finding your investors before you even start looking for deals. A lot of people think, hey, let me find the deal and then the investors will come. Trust me, they don't, and it takes a long time. You really want to be establishing relationships ahead of time so that when you do find a deal, you have a pipeline of people that you can present it to that you've been spending time over the last 6 months, a year, 2 years, 3 years, whatever, that you've been cultivating. And so it's going to meetups. It's going to meet more people. Put yourself in situations where you can meet investors, get on the phone with them, get to know them, create those relationships, find out what they want, right? Because some investors want cash flow. Some investors want, growth stuff, just like any other stock portfolio. So find out what they're looking for so that when you find something, you can give it to the right type of people. I mean, you're not going to give I'll give you an example. If you're doing a development deal that's not going to cash flow for the first 2 years, you're not going to give that to somebody who absolutely desperately needs cash flow, of at least 8% every year. So that's probably step one, is to just get investors in there and start adding value. I think you and I are both on the same page where you do that by adding value, educating investors about real estate, educating about the markets, educating them about maybe, the fact that they can invest with their IRAs. That's a big one for me. I just made a post which I'll be talking a little bit more about that. One of my dear friends, Ken McElroy, who's probably best known for Rich Dad Advisor, he told me one time, hey, look, if I was starting all over again, I would probably just go after IRA folks because they don't even know that they can use that money to buy real estate. They've been just brainwashed to say it's in the stock market. And I don't know about you, but I'm a little bit concerned that the stock market might be a little bit frothy these days, although it has come down over the last couple of days. So just educating the public so that when you do find a deal, then you've got somewhere to go. Obviously, you want to get educated. This is not this is not something to take lightly when you're taking investors' money. You want to know what you're doing. So I would, if you're not already at that level, I would be educating myself left and right. I'd be going to as many seminars as I can. There's plenty of them out there. Maybe even getting some coaching, but just really understand whatever asset class you're going to buy. Look, if you're buying single family homes, that might be one thing, but if you're going to step up to commercial and buying multifamily and buying, 20, 30, 40, 50 unit apartment complexes or more, that's a specific skill set. You don't want to be learning on your investor's dime. If anything, I would probably recommend doing a small one yourself first, so at least you've got something in your back. And then the more tactical thing is obviously in terms of where I come in is once you do identify a property and you start putting in offers, right? And trust me, these days you'll be putting in offers and it'll be rejected left and right because there's so many people out there. So people get discouraged because they do their underwriting, they've gone to all these courses and they know and they submit an offer and it turns out they're not even close because the person who gets it is offering way more. And so anyway, it's just a lot of times, of submitting offers, getting rejected. But at some point, you'll get an offer accepted. And that's when I come in. That's typically when clients will call me. Now, I've probably spoken to them already because people call me, just kind of learn. Same thing for me. I like to get to know people ahead of time anyway, so that when that day does happen, we've already spoken. Hopefully, we've already got a rapport. So it's just we're ready to go. But that's when I would get a call and say, Mauricio, I finally got an LOI accepted, a letter of intent. I need to get in the contract, and so let's start the syndication process. Which, by the way, starts with, if you really want to get tactical now, you're putting our white lab coats on.
Oh, definitely. I love it.
Is putting together the business plan. So that's going to be step one. Once you've got all that preliminary stuff out of the way and you're in contract and you've got your lawyer lined up, then typically we want to see a business plan. And that's not just the OM or the offering memorandum. That's not the property package that you get from your broker. Mm-hmm. You can certainly take information from that and put that into your business plan because you want to have a section in your business plan about the property, right? Just the facts about it, the pretty pictures and all the stuff. But the business plan is where you tell your investors, look, this is what I'm going to do with your $100,000 that you're going to give me, or the $50,000 or whatever. I'm going to go and put it in a down payment to buy this property. I'm going to spend all this money on value add and fixing it up. I'm going to spend all this time marketing it so I can, increase the occupancy once I've improved it. And I'm making all this stuff up obviously. And I want to, increase the rent, and then that's going to increase our net operating income, which obviously increases the value of the property. And then I'm going to either sell it or refinance. Whatever it is that you're doing, that needs to be spelled out in this business plan. And that's always going to be step one.
Now, I'm curious because you're doing a fantastic job walking us through, by the way, and you're going exactly where I want to go. When I start working with you, is my expectation that, hey, let's get on another call. Here's what I drafted. Let's review. Is it like reviewing a paper, or are you going line by line and saying, hey, Ruben, are you sure you want to do that? Yeah.
I thought everybody did this, but I'm probably not. So people get a little shocked. So when I say I got my team, obviously. So either me or my managing partner or whoever, we'll go line by line. We will, when we get a draft of your business plan, we're going to go through that thing line by line. We'll have 1,000 questions, 1,000 comments. We're going to get on a phone call, probably about an hour, to go through those questions and comments. Mm-hmm. Then that gives you homework, because you're going to go do a second draft based on all of our feedback. And again, it just depends on what that first draft looked like. Some clients, look, I've got some clients that have done 30 deals together. They give me a business plan. It's 99% done. I've had other clients give me a 2-page Word document, and we're basically starting from scratch. So, but we'll do the comments. We'll give it back to the client. The client will make revisions. They'll send it back to us. We'll do that again, and hopefully we only have 100 questions and 100 comments this time. And we'll do a third draft, fourth draft. So we do several drafts until that business plan, we're all comfortable that it's done, what I call locked. So if everything's good to go, that's when you can then send that business plan to your list of investors that you've been cultivating over the past specific time frame. And then from there, we start drafting the documentations. There's all these disclosure documents that we have to draft. These are the PPM, the private placement memorandum that you've probably heard of, yep, where we list all the risks and all the disclosures and all the important information for the investors. But while we're doing that, and we're pretty freaking fast, but we'll get it done in about a week. But while we're doing that, the investors are looking at your business plan. You're getting on phone calls with them. You're talking about the deal. You're answering questions. Maybe you're doing a webinar. Whatever it is that you want to do to raise the money. You can't take any money yet, obviously, until they do receive the PPM on the disclosure documents. They have to read all that and sign it. But that's kind of the general process on the syndication side. Now, if we're doing the real estate piece as well, the real estate meaning, we've also, before that, we've obviously we've done the purchase and sale agreement, because that's going to be really step one. And then we're reviewing title. We're working with title. We're working with the lender to get all the documentation for the lender. We're reviewing all the environmental report. All that stuff happens parallel if we're doing the transactional. And then kind of the third parallel, to be honest with you, is also the entity formation. So while all this is going on, we're creating all the LLCs. We're putting together the LLC the investors are going to invest in. We're putting together management companies. We're putting together all these LLCs and drafting those documents so that when finally the investor's like, great, I've got the docs, I've signed. Now they got to go wire money somewhere. So you got to make sure you've got your bank account and all this stuff set up for the money to be received. And that's kind of the semi-last piece to it, because there is one last piece for the States that you're probably familiar with.
Yeah, so that was fascinating. I think you covered all the, or I guess the pieces under your large umbrella where you talk about there's business assessment, there's asset protection, compliance systems, and then there's the offering guidance. And it sounds like for you, it's a one-stop shop, and your team kind of helps you put that together. Yeah. I'd like to. I'm curious as to how much. Because this is where I think the listeners will get a lot of value when I'll ask you the following question in regards to what are the common mistakes or things in question. But how much input is it more? Because I've been there. I'm a licensed broker. I can't compare it to being a lawyer because it's very obviously it's a complete different profession. But in the sense of how much are you giving guidance versus saying, hey, no, don't do that? Or would you consider doing this? Or I've seen my other clients do that. Like, do you try to get that involved, or you try to also protect yourself? So it's not like, hey, Mauricio, you told me to do this, and now I'm in, you know what I mean? Like, I'm curious, right? Like, where do you draw that line of guidance versus support?
Look, this is mostly for first-time syndicators because, if somebody's already done 3 or 4, they kind of know what they want to do. But if it's a first-time syndicator, we spend a lot of time on structure, and we do roll up our sleeves and help clients figure out how to put it together. Yeah. We've seen hundreds and hundreds of these, and so even trying to figure out how you're going to get compensated or what the splits are. Are you going to put a preferred return in there? Are we going to do it as a tick? Are we going to do it? All these questions, I can always say, look. They'll ask me like, hey, how would you do it? And then I've got my answer, based on my experience of seeing so many of these, and I can guide them for sure. And I love doing it. That's actually the fun part of doing it. It's kind of the creative process, which typically lawyers don't get to do. But I love that because, in my mind, there are very few things you cannot do. I mean, as long as we're disclosing things and make sure we're very clear that we let the investors know exactly what we're doing, we can structure our deals pretty much any way we want. And so, I don't want to get too creative because that'll make it complicated and investors will get confused. But, we can come up with some really interesting strategies. And we definitely get involved, especially with the first-time syndicators.
Okay, great. So you've made it very clear that you obviously have the best interest for the LLC or the general partners. Maybe if we're flipping the role, you might have some insight on this because I'm sure you're on both sides here, which is I think is fascinating. What is one thing maybe I should be looking at if I'm reading a PPM or as a limited partner? Are there some things that I should be looking out for that a general partner should be or
for sure.
Offering me, what are some key things maybe that you think?
I think the first thing I would, as a passive investor, the first thing you should be doing is your due diligence on the sponsor themselves. I mean, there's one thing to draw it up on a piece of paper and we can all make up numbers and put them on a pretty spreadsheet, but can they execute? Do they know enough? Are they experienced enough? Do they know what they're doing where they can actually execute and I feel safe with them? I mean, I think that's probably the number one thing. I mean, no matter how great the property is, no matter how great everything looks, if the sponsor isn't good, that's going to be problematic. You can always get, I think, the bad deal. A sponsor can make a bad deal a good deal, but if you got a good deal, the sponsor can definitely make it bad. So that's the one thing. The other thing I think you've got to be aware of, you said something about reviewing the PPM. Let's make sure there's a PPM to begin with. I don't do this anymore, but I used to review other people's, clients would call me and say, I want to invest in this deal. Can you review the docs for me? And so I've got a little bit of experience and anecdotes there. But number one, make sure there's a PPM. If there's not a PPM, ask why and make sure it makes sense. A lot of times people are cutting corners, and if they're cutting corners on the PPM side, where else are they cutting corners? And I see a direct correlation when I hear some made up story as to why they don't have a PPM, even though my client's a non-accredited investor, which is generally required. Then years later, it's happened a couple times where years later they'll call me, literally a year and a half later they'll call me and they're like, yeah, this guy's a fraud and he stole all my money and how do I get it back? So just making sure there's a PPM. But then the other thing, Look, I do think it's worth, by the way, parenthetically, having a lawyer take a look at it, spending $500 or $1,000 or whatever to have an attorney look at it. Because the other thing you want to make sure is that the documents match up. You're going to be probably reading a pretty brochure, a pitch deck, maybe you're looking at the PPM, but at the end of the day, it's all about what's in the operating agreement, because that's the document that really governs what can and cannot be due, what compensations due, what all the processes and procedures are. So if they told you, I'm making this up, but let's give you an obvious one. If they're telling you, yeah, you're going to be getting an 8% preferred return, for example, and in the operating agreement it doesn't say anything about a preferred return, you don't have a preferred return, right? Or if the operating agreement says it's a 7% preferred, you're getting a 7% preferred. So just making sure that the PPM and the pitch deck or the business plan matches the operating agreement. That's another big thing I would look out for.
Okay, that's awesome. So transitioning into the keep it real section. So I'd like to definitely hear what your thoughts are, or what is the biggest misconception that you think people have about raising capital?
That it's easy. There's a great I don't know. There's a great thing. I think that is
like other people's money, right? Just it's just come pouring in, right? Like
I have, this is just a personal opinion, but because there's so much money floating around the system because of what's been going on for the last 10 years, there's just a lot of money out there, and things are going well, obviously, in the economy. So it's not that hard these days to raise money because everybody wants to get into real estate and everything's been going great. So I think that's one of the misconceptions, is just it's easy to raise money. And then that it's easy in general. I mean, I think, you'll be amazed at the amount of people I talk to who are coming in from the single family home, and they think that because they've bought 6 or 7 single family homes that they now are professional real estate investors and they can handle a commercial, and they don't even understand that the lending is completely different, and the requirements of the investor has to have just to get a loan is completely different from getting a loan for a single family home. You get a mortgage, you've got a credit score, you've got income. But if you're doing a commercial, they're looking at the property. You've got to have net worth, for example. People just don't know this. Like, you've got to have enough net worth to cover the loan, even if it's a non-recourse, and you've got to have, a 10% of that has to be in liquid funds. So if you're getting a $3 million loan, you guys have all got to have $3 million in net worth, and after close, you've got to have $300,000 in liquid cash somewhere, either cash or liquid securities like treasury bills or IRAs or whatever. So it's just a different animal. So I think it's just important to understand that you've got to really educate yourself and not just think that because you've done a little bit of real estate on your own for your own account that you're ready to go raise money, because it's a huge responsibility to take on other people's money. This is their hard-earned cash that they've been saving up, and they're entrusting it to you. You better know what you're doing with it.
Now, I'm curious as to the point you just made, Mauricio, about the residential to going a little bigger, and I think syndication is definitely one thing. But would you advise, or I guess from your experience, what do you think the connection between residential and commercial? Would you advise people to get started with residential first, or do you think there's a connection, or would you even say it's just the foundational knowledge of understanding the different animal that you're playing in that should really double down on? Like, is that transition necessary? I know we always hear of it.
Everybody has an opinion on that. Actually, I don't know if it was my post or somebody else's post, and there was a big debate about that. Some people, look, there's three schools of thought. If I'm in single family, that's good enough. Or the one I was really trying to figure out was, if you're doing a 7 or 8 unit apartment building, is that enough? Is that the same as running a 50 unit or 100 unit?
What are your thoughts on that? Yeah,
I think they're different animals. So I would recommend starting with single. I think single. I would recommend starting not with single families, probably with like fourplexes, triplexes or fourplex, just to get your feet wet. But eventually, you've got to make the jump into multifamily. That's really where
and I'm sorry, Mauricio, to cut you off. I just want to make sure I take that point home, because I think you made a really good point. You mentioned to get your feet wet. Do you think that's more psychological, or is it actually analytical? Because we're talking numbers, or is it both? What are we saying here?
I think it's both. I think if you've never if you've never bought a piece of property before, it's going to be really hard for your first property to be a bigger deal. I think just having your feet wet and just having under your belt, you've got 3, 4, 5, or 6 of these units on your own. You're just familiar with legal docs. You've seen what a purchase and sale agreement looks like. You've dealt with lawyers. You've dealt with lenders. Even though commercial is completely different, I feel like you've actually gone through that experience, and it's we always hear about this paralysis. Your first deal is the hardest deal anyway. and it's probably where you're going to maybe make the most mistakes. Why not make a mistake with a small duplex or triplex or fourplex, as opposed to a 100-unit apartment complex with $1 million in investor money?
I get you. Well, point well taken. What is the biggest mistakes you see syndicators make coming into your office? What is something you catch? Is there something maybe at the business plan level?
The biggest mistake, I think the biggest mistake syndicators in general make is that they don't realize what they're doing is selling securities, especially first-timers. First-time investors just don't understand. They're like, why do I have to worry? What it means securities? I'm buying a fourplex and I want to raise $100,000 from my buddies. Like, why is the SEC even involved, right? And so they just fail to see that it's anytime you look, my definition is anytime you take money from investors where the returns are generated by your efforts, you're dealing with a security. If your investors are passive and you're active, you're generating the return, it's a security. And I don't care if there's 3 people, 4 people, it's $50,000 or whatever. So that's probably, and then the more seasoned syndicators, the mistake they make is they think that they can outsmart or get creative, where like, well, if I structure it a certain way, then I get to avoid the securities law. So for example, if I structure it as a tenant in common arrangement where everybody has direct title to the property, or a profit sharing agreement, or a joint venture arrangement, that somehow that, alleviates my need to comply with securities law, or it's a note. That's another one, like, it's not a security because it's a note. These are all securities. The structure itself doesn't matter. It really just depends on who's generating the returns. If you're the one generating and your investors are simply writing you a check and going home, that's a security. That's probably the biggest mistake. And then the ones that I think we've talked a little bit about, the most common other mistakes I see are by far the advertising on 506B deals on social media. That's probably if not the biggest, probably one of the biggest. And then the third one, which we haven't talked about too much, is just people getting compensated or paying other people to raise money for them. Without being a broker dealer. So it's not uncommon, shockingly, that people will reach out and say, hey, if you can raise $1 million for me, I'll give you X percent of my GP, and it's a sliding scale. The more money you raise, the more GP you get. The less money you raise, the less GP you get. It's all contingent on how much you raise, and that's all broker dealer activity. And obviously they don't have that broker dealer license, and so now they're practicing without a license, which for my clients creates a problem because we're not disclosing that, right? Why would you disclose that you're paying somebody illegally or paying somebody that's not licensed? So you don't disclose that, so it's a failure to disclose. And on the flip side, the person receiving the compensation, they're practicing without a license, so they typically will get disgorged, meaning they'll have to return whatever commissions they got plus interest and whatever else happens to them. But I'm less worried about them. I represent the sponsors, the issuer, and that's the concern there, is that you are engaged in an illegal offering because you failed to disclose material facts. And now essentially my clients would be guaranteeing investors returns because they're going to be on the hook for any losses because they didn't comply with the securities laws.
Oh, wow. Jeez. Okay. Well, I guess this ties into the best advice you've sat with someone and given, or you've received in the other seat, yourself being a real estate syndicator. What do you think that would be, or what comes top of mind, would you say?
I think the one that comes top of mind, if it's the one that just you put me on the spot, the one that comes back in mind, don't just take somebody's money just because it's a big check, right? That might be at the end of the day the most expensive money you've ever taken. I've seen scenarios where somebody wants to write you a $500,000 check and you're like, oh wow, this is huge, and you want to do whatever it is to take it, but it may not be right for that person. That person may end up just being a thorn in your side. So just be smart about things like that. I've got a client, I'll say it's right now, who's looking into some stuff that I just, it looks like a scam. I mean, it literally, and I've had other clients fall prey to this where, they're so desperate for funding that they, there's scam artists out there that tell you, hey, I've got $2 million to loan you, and go through some process and, send in some money. And the next thing you know, you send them $50,000 as a, some kind of a fee to just get going. And then that's the last you hear from them, and they run away with your money. So I've definitely been a part of representing clients who've been in a lot of scams like that. So just be careful. When it comes to money, people get carried away and it's like, oh, it's but just be smart about it and do your due diligence and do background checks and get referrals and do all that fun stuff when you're dealing with, anytime you're going to give anybody some money.
Absolutely. So let's hop into the core rapid fire questions, and I'm gonna creep. I'm gonna be a little creep in the lab here. Listen, I see tools of Titans over your shoulder, but I gotta ask you, you got a favorite book? I gotta get back to the fundamentals. What's your favorite book?
Yeah, probably. I've got a couple. So originally I would have probably said, Rich Dad, Poor Dad for me changed my life quite a bit. But recently I was reading a book called Traction by Gene Wickman.
Oh, that's a great one.
Yeah. If you're a business owner and you're looking into that, I think that's a great book. And then the E-Myth. And for me specifically, if you're an attorney, it's called an E-Myth for attorneys. So those are probably the 3 books that come to mind that have really been impactful.
Good for you. Best habit that serves you every day?
I add value to my syndication community.
Nice. Best tool that helps you excel throughout your day?
Best tool that helps me other than coffee. Best tool
it could be an application, could be anything.
It's my computer. I can't live without a computer. I mean, that's what allows me to be virtual, and all of our employees are virtual, and without I guess it's more the internet. Let's just even that. The internet is really the biggest tool for me. I couldn't even fathom doing it without the internet.
What a time to be alive, right?
Yeah.
No kidding. 1 300-unit apartment building or 3 apartments of 100 units?
I don't think I've got enough information to do that, so I'm just going to say I don't have enough info. I
like that answer. I would want someone on my team like you to say that answer, to receive more information. That's just a question I like to see if people like the leverage or 1 roof or multiple roofs. I always like to ask investors. You'd be surprised you get 50-50 every time. A
300-unit apartment complex in Afghanistan or 300-unit complexes in Dallas, Texas, downtown?
Yeah. Okay, cool. Well, great segue. Class A or Class B?
Say that again?
Class A or Class B?
In general?
Yeah.
Any context there, or just literally that's the question? Class A or Class B?
I guess we have a lot of multifamily apartments investors. So if we're talking multifamily,
what do I prefer to be, a Class A or Class B?
Yeah. Like, what do you prefer as an investor?
Class A.
Interesting. Long term. Cash flow or equity?
Both.
Mauricio, you can't have it all, man. No, but you can. Maybe I gotta hang out with you more. Self-manage or outsource, my friend?
Outsource for sure. I don't have any time. I can't do anything myself.
You're the E-Myth guy, that's for sure.
Yeah.
All right. If you have one superpower in your business, what do you think it would be?
It's the ability to take complex securities matters and make them easy to understand. I'm one of the few lawyers that actually speaks English.
I know, and I appreciate you for that. You broke a lot of good value knowledge, which I will kindly share with the rest of the community. This was really, really good. What would you say makes successful, in your case, investor or syndicator? How would you describe a successful investor or syndicator in 1 word, Mauricio?
Knowledgeable.
Love it. I always ask this last question, Mauricio. What question do you wish I would have asked you that I didn't ask?
Oh, such a great question. Can I tell a quick story? That one of the things I was asked, if you go to a restaurant, ask the chef, what's the one thing that everybody orders that you guys are known for? And then ask, what's the one thing that nobody orders but they should? And that's kind of
smooth.
You're
a smooth guy.
Yeah, that's my answer. That's going to be my answer. I'll give you value for I don't know the answer to that.
Okay, no, cool. I always like to put it out there because I feel like, sometimes there's things that we want to say and so I always give the opportunity to share it. But I know the people will definitely get a chance to check out more of your work. Do you want to plug, how can people work with you? You've given so much value. You came in here, you dropped a lot of gems. Where can we find more about you and your team?
You can check. I got a YouTube channel under my name. Facebook, please follow me there because I put a lot of content out there. I'm coming out with an ebook called The 5 Things Every Syndicator Must Know to Stay Out of Jail. That should be out here in the next month or so. So if you want a copy of that, or you just want to ask questions, I'm always happy to answer questions. You can email me at team@premierlawgroup.net.
Absolutely. That's beautiful. And I'll definitely make sure we include all that in the show notes. And I will definitely begin that ebook. I got to support my man. This is great. Mauricio, this was fantastic. Thanks for stepping in the lab, getting the white coat on, sharing with Experiment Nation what syndication is all about. And as an investor and, of course, as a syndicator and as an attorney, and I think it was very valuable, and I do appreciate your time, man.
No, thanks for having me. Really appreciate it, and good luck with everything.
Definitely. And just like that, we are out.